Hi, welcome to another episode of 2 Minutes on Tuesday. I am Sam Miller of RE/MAX Stars Realty, and this week I'm going to answer a question that I've been asked probably a couple dozen times in the last month, and that is, will the housing market crash, and are we going to experience the 2008 housing market all over again? And when they're asking about the 2008 housing market, they're referring to the foreclosure and the short sale market. And none of us have the crystal ball to be able to say with certainty what will happen. But what I can tell you is the dynamics of the current market are very different than the market of 2008. And I'll give you some examples. In 2008, one of the biggest factors that caused the housing market to go through such a transition was that the lenders, the banks, and the government, in fact, the government is the one that allowed the type of loans to happen that happened. And so there were lots of people that borrowed 110% of the value of the home. So if you had a house for even numbers that was worth $200,000, it was not uncommon to hear people that had borrowed the full $200,000 up to $220,000, $240,000, and people were refining their homes and they were paying off their cars and rolling in their boats and jet skis and everything else into their mortgage. And the problem is the values of their homes were pretty inflated at the time. So when the market, it stabilized and values came back to a more reasonable number, the people were upside down. They didn't have any equity in their home and they couldn't sell their home because they owed more on the home than it was worth. And that was devastating for a lot of people. The reason I tell that story is because the market we're in is very, very different. The bank guidelines, they're not allowing 100% or 110 or 120% financing for the majority of the loans. There are unique circumstances with USDA and VA where they can do 100% finance, but it's not the norm, and people are not rolling in other consumer debt and credit cards and things like that into their mortgage for the most part. So the big difference though today versus 2008 is the value of homes has gone up to a point that there's no real reason to have a foreclosure in this market. And the reason there isn't is the values of the homes have increased enough that if someone needs to sell for financial reasons, they can sell and the value of their house has gone up, where they can sell more than cover their costs in most cases. In a lot of cases, actually make a profit on the sale of the home. Where in 2008, they couldn't do that because they owed more on the house in most cases than the home was worth. And that's, you've heard the term upside down. A lot of people were upside down in their home and couldn't afford to sell it without doing a short sale or a deed in lieu of foreclosure where they would deed the house back to the bank and the bank would sell it. So those are key differences today versus 2008. Now I'll give you another one. Prior to 2008, the housing market, we could see it slowing. The amount of housing inventory was starting to build, meaning there were more homes for sale than there were buyers buying. So supply and demand was tilted in favor of the buyer, not in favor of the seller. It was a buyer's market to the extreme. We're at the opposite level right now. There's a shortage of available homes, and there has been for some time. So in order for the housing market to really change and go to a 2008 style market, we would have to have a total imbalance of housing, meaning that a supply of homes would have to far exceed the demand of homes, and that's not happening. Even though the interest rates have been creeping up since January, we haven't seen the shift to a buyer's market because we're still in short supply of available homes. There are still far more buyers wanting to buy than there are sellers willing to sell. There's predictions this year that the houses will appreciate on average nationwide somewhere between 17% to as much as 22%. Now, Knox County is unique because of the size of our community. Most of our homes don't follow the national appreciation rate, where some markets might go up 10% in a year, we might say 3 or 4, but we still follow the trends, just not to the extreme of, say, the big metro markets. So hopefully this is helpful. I don't see the market crashing anytime soon. There will be signals when the market is shifting, and that will be the number of showings on homes will slow down. The number of multiple offers when we list a home will be fewer. And the days on market, how long it takes for a house to go from listed until under contract, it will stretch out. It will take longer for houses to go from listing to pending, and that'll be the signs that the market is slowing. If you start seeing houses for sale on every corner, and I'm not talking about arrow directional signs creating an illusion there's more homes for sale than there are. I'm talking about if you drive down the street and every house is for sale, that'll be a sign the market is shifting or has shifted. But we are certainly not seeing that at this time. So I'm Sam Miller, RE/MAX Stars Realty. Hopefully this is helpful. Feel free to reach out to us if you have questions. We're here to help. Real estate's what we do. Our phone number, 740-397-7800. Have a great one. Sam Miller, RE/MAX Stars Realty. Come back to you next week. Bye.